Investing is hard. The market, unpredictable. Wall Street, it may well be a casino in disguise. But amidst the chaos of meme stocks and crypto schemes that make Beanie Babies look like a sound investment, there was a guy. One guy to rule them all. One guy to manage $18 million. And in the darkness turn it into 14 billion. He didn't use any gimmicks, no algorithms either, just plain old-fashioned common sense. He found game-changing stocks before your cousin who knows a guy started blabbing about it on Facebook. His name? Peter Lynch, Wall Street royalty. One of the greatest fund managers of all time. Peter laid out 13 characteristics he looks for to identify winning stocks in his book, One Up on Wall Street. This book. And today, we're going to dissect each of these traits with real-world examples so you can start thinking like a pro investor yourself, or at least sound like one at your next family dinner. Giddy up. So, who's Peter Lynch? Peter is a man in finance, 5'8", blue eyes, has a trust fund. Well, managing one, at least. The Fidelity Magellan Fund from 1977 to 1990. A time when bell pants, long hair, and stock tips were passed around on actual paper. And during that time, he achieved an astonishing average annual return of 29.2%. That's nearly double the S&P 500's return in that same period. Under his leadership, the Magellan Fund ballooned from 18 million to over 14 billion in assets, making it one of the most successful mutual funds of all time. Think about that. He took the equivalent of a small Powerball jackpot and turned it into enough money to buy a lot of golf clubs because he liked golf. Lynch is famous for his invest in what you know philosophy, whether it's the products you use or the industries you work in. Unlike Warren Buffett, who focuses on long-term moats, or Jim Simmons, who relies on complex mathematical models, Lynch believed that individual investors could beat Wall Street simply by identifying strong businesses before the broader market has caught on. He thought that you could have an edge just by paying attention to the world around you. Regardless of whether this is still entirely possible given the efficient market hypotheses and the speed with which data and information is assimilated by the market, Peter's principles are more relevant than ever. Meme stocks, AI hype, the chaotic affair between Trump and Elonia, investing in what you know is as sound an advice as ever. So let's get into it. The perfect company does not exist, but if you could dream it, then you know how to recognize favorable attributes. These are the 13 most important ones according to Peter Lynch. 1. It sounds dull or even ridiculous. Lynch loved companies with names that would make you fall asleep at a party. Think Bob's Discount Widgets or Acme Sprockets. Why? Because the hot sexy companies like Quantum Leap AI Hypergrowth attract all the Wall Street sharks, driving up the price. But boring ones, they fly under the radar. Remember Blockbuster? Sexy name, sexy business model of renting physical tapes, and how did that work out? Now, a company that makes, say, industrial adhesives, dull as dishwater, but everyone needs stuff to stick together. Literally and figuratively, folks. Companies like WD-40, simple, boring, and highly profitable. Another great example is Old Dominion Freight Line, a trucking and logistics company. Not exciting, but it has outperformed many tech stocks. In fact, it's the 6th company with the best return of the last 25 years. with over 32,000% in total return. I'm not gonna tell you how much 10K would have become if you had invested in this. A lot. Second, it does something dull. Forget about the next revolutionary AI-powered, blockchain-integrated, metaverse-ready dog walking app. Lynch liked companies that did something fundamental, something that people will always need, like toilet paper, or toothpaste, or beer. You know, the essentials. Because even when the economy tanks, people are still going to need to wipe their... Well, you get the idea. Try explaining the intricacies of your NFT collection to a guy who just lost his job. He's probably more interested in a six-pack and a roll of Charmin. 3. It does something disagreeable. The best stocks aren't always glamorous. Sometimes it's even better if they work on unpleasant things. No analyst wants to follow a funeral services stock or become an expert on waste management. Hey, what's your coverage looking like this quarter, Jake? Oh, you know, just death and garbage. Not exactly a headline grabber. Likewise, you're not going to be popular during Thanksgiving if you start talking about toxic waste and how this is a great industry to invest in. Please, could you pass the gravy? And did you know that margins on hazardous material disposal are through the roof? Nonetheless, this could give retail investors one up on Wall Street. Necessary but unappealing businesses are often overlooked. Fourth, it's a spin-off. Spin-off companies often perform well because they can focus on growth without being weighed down by a larger parent company's bureaucracy or broader challenges. Also, parent companies usually ensure that spin-offs have strong balance sheets and are well positioned for success before setting them loose. And if the people running the new, smaller company start buying up the stock, well, that's a pretty good sign they think they can actually make this thing work. An example is Carrier Global, which was spun off from Raytheon Technologies. Since becoming independent, Carrier has grown significantly in the HVAC industry, grown 3 times more than the S&P 500 to be more precise. Fifth, institutions don't own it, and analysts don't follow it. Stocks that fly under Wall Street's radar have more room to grow before the big players jump in. Untapped potential. These ignored stocks might offer significant opportunities for gains before they become mainstream. Lynch said that, and I quote, "When I talk to a company that tells me the last analyst showed up 3 years ago, I can hardly contain my enthusiasm." A recent example is Celsius Holdings, a beverage company that was once overlooked but gained popularity among retail investors before institutions took notice. Sixth, rumors that it's unexciting or in trouble. The market loves to overreact. A little bad news, a temporary setback, and suddenly everyone's hitting the panic button. But sometimes that creates an opportunity. If the underlying business is still solid, a little bit of bad press can lower the stock price, making it a better buy. Look at Meta in 2022. Many thought the company was doomed due to high spending on the metaverse and declining ad spend, but it rebounded strongly as its core business of, tracking our every move and selling us targeted ads remained wildly profitable. Seventh, there's something depressing about it. Companies operating in industries dealing with the less pleasant aspects of life often have consistent demand. Here, Peter talks about Service Corporation International, a provider of funeral goods and services, as well as cemetery property. The best thing about this company is that it was shunned by professional investors for years in the 80s, and retail investors had plenty of time to buy up on SCI. An example of this is Altria, the company behind Marlboro cigarettes. While the tobacco is often seen as controversial and somewhat depressing, Altria has delivered consistent profits for years, making it a dependable investment despite the negative stigma of the industry. Eighth, It's a no-growth industry. Fast-growing industries attract too much competition. Think about it. For every single product in a hot industry, there are 1,000 researchers and engineers trying to figure out how to do it better or cheaper. As soon as a computer company designs the world's best processor, 10 other competitors are already spending billions to design a better one. And it will be in the market in 6 months. But in a slow growth sector, like say cleaning supplies, a company like Clorox can just keep doing what it does best, with strong brand loyalty and reliable cash flow. Sometimes boring is good. 9th, it has a niche. A company that dominates a small overlooked market can be a big winner. Lynch was a fan of companies that dominated a small specific market. Think of the company that makes those little plastic things on the end of shoelaces. You know, the eaglets? Who else is doing that? Probably some guy in a basement somewhere raking in the dough. It's like being the only bar in a desert town. You don't need to be the biggest, just the only one that matters to a certain group of people. Or in this case, shoelaces. 10th, people have to keep buying the product. This is key. Lynch loved the razor and blades model. You sell the razor cheap, and then you make a killing on the replacement blades. Think Gillette or printer ink, or dare I say it, those ridiculously overpriced charging cables Apple keeps innovating. It's like a hostage situation, but instead of a ransom note, you got a notification that your ink cartridge is low. Again. 11th, it uses technology to stay ahead, not define itself. Lynch wasn't necessarily looking for the company creating the groundbreaking technology. He preferred the company that was using it to improve their existing business. Think of your local dry cleaner who now uses an app for pickup and delivery. They're not inventing the app, but they're using technology to make their core business more efficient. It's like your grandpa finally figuring out how to use email. Not exactly cutting edge, but he gets the job done. 12th, the insiders are buying. This one is pretty straightforward. If the people running the company are buying their own stock, it's usually a good sign. It means they believe on the future of the business. Of course, sometimes they're just trying to pump up the price, but generally, it's better than seeing the CEO frantically selling off his shares like he just saw the Titanic hit an iceberg. 13th, it's buying back its shares. When a company buys back its own shares, it reduces the number of shares on the market, which can boost earnings per share and increase value for shareholders. It's like when you were a kid and your parents bought back your bad report card. Wait, no, that's not a good analogy. It's more like the company saying, hey, we think our stock is undervalued, so we're going to buy some of it ourselves. It shows confidence. There you have it, Peter Lynch's 13 elements to spotting great stocks. So next time you're at a grocery store or stuck in traffic, maybe you start looking at the world a little differently, not just as a consumer, but as a potential investor. If you found this helpful, make sure to like and subscribe for more investing insights, or at least for more of my questionable jokes. And let me know in the comments, what's your favorite investing principle from Peter Lynch? Or maybe just your favorite boring company. Thanks for watching, and I'll see you around. Ciao.